Building energy infrastructure out in the open ocean requires capital deployment and rigorous engineering on a massive scale. In the second quarter of 2026, the Petro-Vietnam Technical Services Corporation, PVS, recorded a profit after tax of 562.55 billion VND. That figure represents an 80% year-over-year increase. This is the official explanation letter submitted to the State Securities Commission. PTSC specifically links this growth to final contract settlements with their core customers. This chart tracks quarterly revenue and net profit since 2024. Following a 25% profit increase in Q1, the Q2 breakout establishes a clear operational trend. Despite these numbers, a segment of the market continues to price PVS based on the daily fluctuations of Brent crude. The underlying revenue drivers have shifted. The company now generates value through the long-term delivery of energy infrastructure, independent of short-term oil pricing. To accurately price PVS today, investors have to look past the global oil charts and deconstruct the exact financial architecture that engineered this 80% profit result. This chart breaks down the company's margin by segment. The primary catalyst for the Q2 surge is sitting right here. The mechanical and construction sector saw its gross margin leap from a baseline of 1.2% to 9.1%. These earnings stem from core business operations as PVS completes instruction milestones and settles accounts. This diagram maps the life cycle of capital on the PVS balance sheet. Step 1. PVS signs a multi-million-dollar contract, which adds to the backlog and triggers immediate customer cash advances. Step 2. PVS uses those advances to procure raw materials and mobilize labor at their fabrication yards. The capital pools here, expanding the work in progress, or WIP. Step 3 occurs when PVS hits a specific project milestone. At this point, the accumulated work in progress translates into recognized revenue and realized cash. The provisions and WIP that PVS quietly accumulated over the previous quarters have now transitioned into reported profit. Based on this cash realization, management has upgraded their internal targets for the second half of 2026 to 34,000 billion VND in revenue and 1,500 billion VND in pre-tax profit. These results represent the terminal phase of a multi-year project cycle finally reaching maturity. Supporting this operational engine is what analysts call a diamond capital structure, a financial framework built to maintain stability through macroeconomic volatility. At the core of this structure is a massive net cash and short-term deposit position that consistently exceeds 12,000 billion VND. This visualization compares that cash hoard against their obligations. PTS holds over $12,000 billion in cash against a projected short-term debt of roughly 534 billion VND on an equity base approaching 18,450 billion. They maintain this ratio through aggressive capital appropriation. Massive customer prepayments, like the 935.4 billion VND from the Long Fu 1 project, allow PVS to fund vast operations without touching interest-bearing bank debt. The secondary defensive layer lies in aggressive warranty provisions. In recent quarters, they booked 415 billion VND for the Low B project and 134 billion VND for Baltica 2. By setting aside these funds today, management builds a financial safety net that will eventually be recognized as income. We will see the impact of this soon. As the warranty on the Sao Vang Dien Viet project expires in 2026, an estimated 600 to 630 billion VND in provisions is scheduled to be reversed back into profit. This balance sheet acts as a shield against rising interest rates while securing future earnings growth. The driver for the 2026 to 2030 cycle is the mechanical and construction backlog, which currently stands at an estimated 6.4 billion USD. The first pillar of this backlog rests on domestic traditional oil and gas megaprojects, specifically the Low B chain and Lac Da Vang. This photograph illustrates the massive scale of these domestic energy projects. Lac Da Vang is rapidly approaching critical completion milestones in Q4 of 2026. Upon achieving first oil in Q4, the Floating Storage and Offloading Unit, or FSO, for Lac Da Vang will begin generating an estimated 76,000 USD per day in leasing revenue. FSO leasing creates a highly predictable revenue stream for PVS, insulated from the execution risks of EPC construction. The second pillar of the backlog is a $2.8 billion USD portfolio in international offshore wind contracts. This grid of offshore wind turbines manifests a technical shift. PVS leverages its maritime engineering expertise to build renewable infrastructure for the global market. Execution on these international contracts is moving forward. Fabrication for the Baltica 2 project in Poland and Fangmiao in Taiwan have already surpassed 95% completion. Based on the delivery timeline for these projects, the largest volume of recognized profit will appear on the balance sheet in late 2026 and continue throughout 2027. This diversified backlog secures PVS's long-term revenue visibility, regardless of global oil market volatility. Executing offshore megaprojects involves high logistical complexity. A massive backlog requires disciplined management to preserve profit margins. To evaluate the downside, we can map the quantifiable threats to PVS over the next 3 years on this risk matrix. European offshore wind projects impose technical standards and financial penalties for project delays. The 134 billion Vietnam provision for Baltica 2 reflects these pressures, accounting for the costs of international expert labor and quality control requirements. There are also upstream commercial risks. If final power and gas sales agreements for the Low B project are delayed, the resulting friction could stall project cash flow. Finally, raw material costs. Because PVS operates on fixed-price EPC contracts, fluctuations in steel prices and specialized equipment can reduce margins. While a $6.4 billion backlog secures work, realizing the bottom-line profit depends on penalty-free execution in a demanding environment. We can frame PVS's trajectory over the next 12 to 24 months across 3 distinct execution scenarios. The bull scenario depends on project execution that preserves margins and rapidly confirms cash flows from Low B and international wind contracts. The bear scenario occurs if upstream investment decisions are delayed, material costs rise, or strict international contracts trigger penalty provisions. The base scenario recognizes that while long-term profit will grow, project timelines will experience friction, requiring investors to navigate periods of higher volatility. Looking at immediate catalysts, PVS recently approved a 20% stock dividend, expanding their charter capital to over 6,137 billion Vietnam to fund this cycle. Management has also initiated plans to shift their listing to the HOSE exchange, positioning the stock to capture capital inflows from major funds. Major financial institutions have set consensus target valuations, ranging from 46,000 to 64,000 Vietnam per share. Valuing PVS today requires shifting focus from oil price speculation to the company's cash reserves, their backlog, and their execution capabilities. The true measure of the company is not a single quarter of growth. It is whether they maintain the discipline to convert a multi-billion-dollar backlog into realized cash across the 2026 to 2030 cycle.